Hi, I'm David Joubert from Kingdom Houses, and welcome to the second Landlords Seminar that I'm hosting. This session, we will be covering mortgages and the new Green Deal Home Grant. And we will briefly say hi and goodbye to our previous guest speaker, which is Mike from Maplebrook Wills, which is a fantastic session. If you missed it, there's some really important stuff there, specifically regarding saving on your capital gains and on your inheritance tax. So, Mike, introduce yourself again.
Hi, I'm Mike Pugh with Maplebrook Wills. We're specialist estate planners dealing with end-of-life planning and mostly taxes. I wish it was more exciting.
And so the mortgage broker Payam is just having some trouble connecting, but he'll be in shortly, and then we will take it from there. So without further ado, I will start the presentation. Property Seminar 2. Mike, so on the agenda, Mike will do a 5-minute recap. I'll talk about a few things, and then Payam will get to the mortgage session. So Mike, if you want to take it from here, I've got your brochure up here, and let's zoom in there and get into the meat of it.
Sure, brilliant. Thank you, David, and thanks for inviting me back. Hi, John and Anish and Gala and all those watching from home. So what we do is we help landlords who own properties to avoid paying away substantial sums on death. I had a call just this morning from a chap over in Milton Keynes who had a friend of his die with a 2.8 million pound estate, and he'd been hounding him because he's a will writer and because the guy was his friend. Of course, that meant that nobody's going to do anything, and because humans. And sadly, he died last night of massive heart failure. So there's a 720,000 pound IHT bill payable on 1.8 million pounds. And the wife and the kids aren't really happy about that, but sadly, that's how it works. So wouldn't it be nice if we could bring that to zero? Wouldn't we be nice if we could stop the 720,000 pound bill from getting paid? And the answer is we can. We can actually bring it to zero with a little bit of planning. We have a product at Maplebrook which focuses in on people who own multiple properties. I don't deal in cash assets. I'm not an IFA. I'm not regulated through the FCA. I'm an estate planner. And all of my compliance is done by a doctor of law who is our head of technical support. But in a nutshell, what we can do is we can help people who've got more than 4 properties outside of their principal residence, bring their inheritance tax liability to zero. Because they can mitigate inheritance tax liability, what that can also do is reduce capital gains. Certainly, we can wash out any historic capital gains, bring that to zero. And we can bring stamp duty down to zero. It's not a silver bullet. It takes 3 years. There's no need to cut corners. If you've got something that works and it's legal, why would you try and cut a corner? I've heard some accountants will set up a partnership and collapse it within 6 weeks, and then it's a head shaker because you don't understand. In the fine print, it says if you let these things run for a certain period of time, it's all completely legitimate. So there's no point in trying to abrogate the time. It's going to take 3 years, but 3 years is great when you consider that 720,000 pounds for this gentleman who sadly has passed away could have been saved if we had done the process starting obviously 3 or more years ago. I guess that's kind of the elevator pitch, which is my 5 minutes. It's just a whirlwind, but we do get a lot of questions from people. Because it takes a long time, people generally are, and properties are generally expensive, people are naturally concerned about making sure that they're doing the right thing. We'd be happy to have a free consultation and put together a free feasibility study if that was something that you'd be interested in, and then answer questions and take it from there. We don't require all the monies up front or anything like that. Monies that are used for this process are generally paid in 3 tranches over the 3 years. So the risk element is reduced significantly. Nobody's going to be asked to put a whole bunch of money up front, as it were, and then what if they don't survive the 3 years, or et cetera. So we've done everything we can to bring risk well within control. And it's been a very busy couple of months. You might be able to see from my face. I've been kind of tired. I don't know what else to do here, David. I believe we saw John and Anish on the call last time. Happy to answer any questions you might have. It's been, what, a month or more since we last saw each other.
I guess if I'll ask a question, if you don't mind, and it was useful when we met last time, just to turn over this whole question of consolidating properties. Across the family, we do have probably 5 properties, yeah? Mm-hmm. And you've got to have 4. So I was thinking about the hassle, if there is a hassle, and there probably is, of pulling all those together and then looking in the longer term, because we've got to really declare we're going to hold on to these properties.
Here we go. Here we go. Hello there. Can anybody hear me?
Hi, Payam. It's Mike Pugh over at Maplebrook.
Okay, great. Sorry for that, guys. We had a big technical challenge here getting Payam to join, but finally we're in, so that's excellent.
Yes.
So everyone, Payam, you can introduce yourself.
Hi there. I'm just going to go and turn this on. Now, can you guys see me?
Yes.
All right. Hello, everybody. Yeah, apologies. We were having some technical issues there. So we finally managed to get there. Right. Yes. So my name is Payam Azadi. I'm a director at Niche Advice. We're an independent whole-of-the-market mortgage brokerage, and I've been dealing with David for a number of years now. This session is really around mortgages and specifically investment property mortgages. And I've put together a little sort of agenda, I suppose, we'll run through. And then afterwards, I can take questions from everybody if you've got any specific questions. So really, let's crack on and let's go to what's happening. So,
Payam, so you're after me, so we're just waiting for Mike to finish. He was just doing his quick recap.
Good.
On the previous session.
I think I'm just about done. John, if you'd like, you can give me a call and I'll be happy to answer the questions in an unrushed.
I'll do that. I'll do that separately. I think it's, it's a fairly easy question in some respects, but I'll come back. I'll follow up after this.
No problem. Okay.
Perfect. All right.
Again, David, thanks for the invite. I do have to get going because I've got a meeting in 12 minutes over in Cleveland, about 4 miles from here. I've got to jump in the car and skedaddle.
Perfect.
Thank you very much, guys.
All right. Take care. Thank you.
Bye-bye.
Cheers.
Okay, great. And I see we've got more attendees now. Taking back to the screen share. So this is the agenda for the session. So we've had Mike do his recap. I'll have a quick speak about the opportunity, the market update, changes to evictions. And then we're going to hand over to Payam from Niche Advice. And if you have any specific questions, I think that's where the real value comes, is to ask him a direct question. All right. So last time I was supposed to reveal this opportunity, but it kind of slipped the agenda. So I've moved it to the start of the session. We have one landlord within Kingdom Houses that is trying to exit, and we've basically put together their house as an opportunity for someone if anybody wants to take it over. This presentation, this brochure will be available, and I'll attach it to the email. Very roughly, it's a 6-bedroom house turned into an 8-bed HMO. It's turning around a 5.4% ROI if you buy it with a mortgage, based on some numbers that I've run. And at the moment, it's paying a £4,000 a month rental, which is based on the current condition. And that goes up based on the works that I've proposed and a few photos. So it is an opportunity if someone's looking to enter the market, and the location is extremely well placed, right close to Ealing Common Station, less than a 3-minute walk. Yeah, so that's that opportunity. If anyone has any questions about it, you can ask, but probably we can take those offline at another time, and I'll be sending the brochure over. Getting us back to our presentation. Okay. So, quick update. What's been happening in London? House prices have not really been impacted yet, and that's not surprising considering the stamp duty holiday and considering that furlough has not ended. London has seen a drop, and the big issue is that there is this projection that London might see a further drop. So if you're looking to buy, I think the bottom line is it's time to be patient. There will be further downgrades and you will get an opportunity to get into the market. I think that the reduction on the rents will exceed the discount from the stamp duty holiday. So I wouldn't advise anyone to sort of rush in on the basis of the stamp duty. Rents in London are down 4.2% year on year. Not that surprising there. We've known that rents were going to be down. A little bit of anecdotal experience from Kingdom Houses. So we've seen room rents down from 20% to 0%, really depending on the room and the specification of the property. It seems that the lower end units are suffering more. And I think that just simply reflects that people have more choice. You know, there's more choice in the market now. And people are taking the opportunity to get something nicer for the same price. Okay. Evictions, so the legal changes, they keep changing this. I think that what they've made now will probably stick for a while. The biggest issue is that the bottom line is you can't really evict people. They have to really be the devil. You can't evict someone just because you want your property back using a Section 21. And all the rest if they're refusing to leave. So that's ridiculous. And for Section 8 notices, there are a few unique grounds that you can evict for. The antisocial behavior ground, I'm very grateful for because that's an important part of administrating and managing property. However, the more than 6 months rent arrears, it feels a bit mean. In the end, it means that really your tenant had to have stopped paying the rent from March. So essentially they were already in arrears before COVID struck, which is essentially there's a signal saying, look, any rent arrears that tenants built up between March and September, you just have to eat it, just cover it and let them make it up later. The worst part is the recent Tenant Fee Act means that you can't enforce your punitive late penalty charges, 8% interest rate and the rest. What you're allowed is 3% over the Bank of England rate, which at the moment is 0.1%. So you can charge your tenant 3% interest, 3.1% interest, basically. And they can go into arrears up to 4 months and there's just nothing you can do about it. So that probably links in with the previous session where I recommended that you take the holiday on your mortgage payment. And I took mine and actually it came in very handy because one of the tenants in Cheltenham, family, he has a wife and kid, he lost his job. He had to get on benefits and that introduced an 8-week delay. So now he's actually paid me all the money, but the delay was there and having that cash flow was obviously helpful. Now to the more exciting bit. Believe it or not, the UK government wants to give us free money. And they are doing this because for whatever reasons, they want to be green, they want to boost the house building, they want us to get our EPCs up and we will take it. Very rough summary, you put in 2.5K, the government puts in 5. So that's a massive, 200% ROI on your investment. There are some conditions. Having an EPC is not actually part of the requirement. You just need to get someone to quote for the work and then apply for it online, like to get a voucher. However, if you get the EPC, it can be very helpful for you to link the work to your bills saving, your expenses. They've split up the work in what they call primary and secondary work. So double glazing, for example, is secondary work. And if you want to do double glazing, you have to do some primary work as well. So obviously the best thing to do is to split your £7,000 50-50. Boilers are explicitly excluded and so are solar panels, although not solar heating. So solar heating is where they've got the tubes on the roof and the water goes through the tubes and the water heats up and it's more efficient than solar panels that then heat the water directly. Breakdown of primary and secondary work. I'm not going to go through everything. You can read the slides later. 7.5K will not go that far in London because it can be expensive. For a large house, I'd expect that you would end up spending close to 10K, maybe more. but you're still getting some free money. So it's definitely worth it to investigate. What I'm going to do now is I'm going to actually open up a few EPCs that I've handpicked to show kind of what can be achieved and the kind of thing that you would be able to achieve. So this is one of the units that we manage. And you can see the EPC rating here is particularly low as an E. Kindly note that a rating of F is fail and they're illegal, but more importantly, the rating of E will become unlettable. The government has set out a schedule for these EPC ratings. And when you fall behind, you won't be able to get a new tenant. So taking this house, for example, on the EPC, they usually put estimates. I think the costing on these estimates are a bit laughable when it comes to the cost of doing building work in London. You probably think that it's going to be double the indicative cost that they've put on the EPC. However, both of these are primary works. So if this landlord opted to do both jobs, assuming that price, it double that price, the spend is 5.4K. So, right there, you can put in 2.5K, get 5K from the government, and find a secondary work that you want to do on your house that covers the cost. That's what I would do with this property. And they also show you how it links into a few other ideas on energy savings. Heating controls, so that means, for example, Hive Home, Tardu, or putting thermostatic radiator valves on the radiators. And also solar heating, so that's where you heat with the water. The typical savings in solar heating is pointless, to be honest. Let's look at another one. Ellis Road, I like this one. This house has got single glazing. So it's interesting. This house's rating is the same level as the previous house, although the previous house has double glazing. So I'm not convinced how accurate these EPCs are as a scientific measure, but they're definitely interesting. And we can see for this house that there is massive amounts of work that can be done. So this landlord will benefit massively from the works. And of course, Kingdom Houses in turn would be very grateful that the houses have an improved efficiency. It just makes it better for everyone. And here we can see that they've done an assessment on double glazing. And I don't think that their assessment is accurate because the rent, the gas bill that we pay on this house is £300 a month. And almost probably 150 of that is going out of the windows. So, I think that the typical savings per year is going to be £1,000, not £99. These EPCs have usually been done on the basis of some family living there that keep the heating low. When we talk about HMOs, it's always going to be much, the savings will be much higher. Another one that needs double glazing. I think these are the only two in the portfolio. And surprisingly, this one's come in at a D. The same thing again, internal or external wall insulation. So that's your primary work. And then secondary work here, double glazing. This house, we actually have a quote for the double glazing. It's £20,000 to do the whole house. It's particularly expensive because the windows have arches at the top. And to redo it with double glazing sash windows, wooden ones, is very expensive. It could be £10,000, but then you would have to brick up the arch, and that would affect the character of the property, which is something that the owner did not want to investigate and look into. And it can make a difference when you sell your house, when having these character features. Here's one that's got a good EPC rating. So the landlord here doesn't have really that much that he will benefit from. The solar heating on water heating could be an option to look into. The savings per year, again, I expect it to be triple that level since Kingdom Houses uses a lot of hot water. But yeah, it could be worthwhile to look into. I'm not a fan of putting something on the roof unless you're going to save a lot of money, because you introduce a new vector for leaks and additional maintenance. So yeah, those are some of the EPCs. Interesting stuff, as you can imagine. I've got hundreds of them, and they all look really the same.
David, did you say that if a house has an EPC rating of F, it's a fail, and E is effectively a fail as well. Is that
F is a failure right now, I believe, and E is going to be in the future. And you can expect that to get increased as well, the timeline. You know, they're pushing this.
And what is that? And it's illegal, and they're, by 2025 it will be illegal.
So if you do a new tenancy, you can't rent out. Unless there are some exceptions that they make if you can't improve the house. If it's a grade listed building, I mean, these exceptions generally don't apply to most people I talk with. So in most cases, you'd have to consider double glazing, some insulation, and you'll be at the level of E or close to D, right? For the handful of properties that we have, the two that have single glazing, probably those will be forced into upgrading their building. And we have one building that has got what is called Economy 7 night storage heating, which is electrical. And that house has a ridiculously bad EPC as well. And we know it, like it's actually factually true, because on that building, we pay, and you're not going to believe it, but we pay something like £5,000 a year on the electricity. So we're spending 400 a month. And in summer, you don't spend anything, right? So this is 3.5 grand of energy spend over the 6 months of winter. Stuart.
Does it cover better hot water cylinders, for instance?
It does, yes, it does. If a water cylinder that doesn't leak the energy is covered, insulation around the water cylinder is covered. So there's a lot of cool things that are covered.
There's quite a lot of innovation around hot water cylinders now, such that they become more intelligent and they only heat as much water as is needed. A bit like your kettle, where you only put enough in for the amount of cups that you're going to use. But there's some quite clever ones that rely on the turbulence, and I won't go into all the techie stuff now, but that would be quite interesting, I think, because most I would imagine a lot of houses in the estate that you're managing have got hot water cylinders in them.
They do, but then with our usage, we're such high occupancy, we empty the tank daily, right? So it would be such a saving for us. One thing to note, this excludes new builds, which I've not seen a clear definition of what is a new build. So it's unclear to me whether my property that's 10 years old qualifies. You know, every house was a new build at some point. And the government set aside 2 billion for this. But there's 23 million dwellings in England, right? So if everybody goes for this, it's going to run out of money really quickly.
And this is including private dwellings as well. So our own domestic residences apply.
Absolutely. It's available for any property owner. So landlords and private tenants, and actually private tenants that are on low income can get 10,000. So people that own their own home yet have benefits or job seekers or this or that can get up to 10,000 contribution, which is, it's interesting. I think the government, they want to eliminate the low EPC, or rather the house performance poverty, right? You know, they don't want people living in homes that has damp problems and leaks energy. And all of this helps to improve the stock.
Does that money need to be spent by March 21?
Yes, it does.
So, I mean, immediately you're going to have an issue with finding enough tradesmen to do anywhere near that amount of work.
Absolutely. And the price is going to go up. And so actually you're going to lose some of your discount if you think about it, right?
You're not going to be able to manage, they won't be able to manage to spend 2 billion in less than 6 months. No way.
So that's what the official stuff says. You need to get your voucher and get the work done before the end of March. And if you take my case, for example, if I had to call a company, which is something I intend to do, and visit 50 properties, which is how many we look after, I don't think I can get through just doing the assessments by March.
No.
On top of the normal workload.
Unless you've actually got a job pretty much ready to go now, with a quote in your hand.
Yes.
And a relationship with a tradesman, you won't even get somebody booked in to do.
So this is why I want to involve my landlords, because if each landlord gets involved in his own home, we can get it done, right? But if I have to be the bottleneck managing 50, it's going to be impossible.
No, you won't. No.
But what we can do, and a good starting point, is to grab your EPC, because that's going to tell you what you can do. The price might be off and the savings might be off, but it will tell you what the options are.
Yeah. Okay. No, thank you.
And that's essentially it. I mean, that's quite exciting stuff. That's quite useful. And I don't know why he thought of it. Rishi, he just pulled it out of the air. Another one of his schemes. but definitely a good thing. We can do more questions at the end of everything. It's the next step is to hand over to Payam, who's going to tell us every single thing about the mortgage world and give us that secret on how we can get a 0.1% mortgage.
There are no secrets like that, I'm afraid, unfortunately. Right, guys, thank you. Sorry for the premature entrance at the beginning. Right, so my name is Payam. I'm a partner at Niche Advice. I'm one of the directors. The company's been going for 12 years. Previous to that, I've been in the financial service industry for about just over 20 years now. I was a director of one of the largest mortgage companies before the crash. We had about 3,500 brokers, and we had 450 staff in Tottenham Court Road. That sort of, when the market crashed, that sort of went down. I was thankfully not the shareholder of the company, but one of the directors. And myself and Richard Stokes, who's now my partner, we set up Niche Advice about 12 years ago. And we've been sort of managing mortgages, whether it's residential, buy-to-let, HMO, commercial, a bit of everything really. We've got a very successful website that's been running now for 12 years. We get about 15,500 visitors to the site a month. We've got a YouTube channel as well, which I host, and we've got about 1,500 to 2,000 subscribers to it. In terms of the challenges, what we will do is we'll talk about how COVID has affected the mortgages in the first place, and then we'll go right the way through some criteria changes, as well as talking about sort of HMOs, portfolio landlord changes, and some of the things to watch out for really, and some of the opportunities out there that we're working with the landlords, and we deal with nationwide, so it doesn't really matter whether a property is in London or it's in Scotland. We've got many landlords all over the place. We're a small business, but so it works because I deal with everybody in regards to most of the clients I personally deal with. I would say 70% of the business tends to go through myself. So that's the YouTube channel we've got, and we talk about various sort of strategies out there. So let's talk about COVID. So COVID has been a massive, obviously with everything, with every industry. As soon as COVID kicked in, a lot of the lenders pulled out of the market. The reason for that, and you've probably got mortgages with them. The reason for that is there's two funding channels, the way lenders get funded. One of them is balance sheet funding. So your Nationwides, your Halifaxes, the big banks, they work off balance sheet. Then you've got the challenger banks and the specialist lenders. They tend to securitize their money. So what they do is they actually get their money from the financial markets, from the funds, and then they essentially package that up as mortgages, and then they'll go and sell that on. So as soon as COVID happened, and exactly the same as the last time, those funding channels closed shop. So what happened was you saw lenders like Vida Home Loans pull out of the market, Together pull out of the market, Precise pull out of the market. And although Precise is a balance sheet lender, it's part of the One Savings Group, which Kent Reliance is a part of. So you saw a batch of lenders saying, we don't have any money to lend, okay? And you had a number of other lenders that did have money to lend, but they got inundated. And it was interesting because you said about the payment holidays, they got inundated with payment holiday requests. Now, most of these lenders have only got 20 staff manning the desk on the calls because they're reliant on the broker community to do a lot of their essentially communications and selling. Okay, so they had to literally close all of those desks to be able to field payment holiday requests. Okay, and we'll talk about payment holiday and how that will affect future mortgages and what lenders are doing about payment holidays. So COVID, basically what happened was initially a lot of the specialist lenders pulled out of the market. Loan to values came down. So, your normal 75% loan to value deal was dropping down to 60, 65% with some lenders. That's now thankfully gone back up again. And we've seen those lenders start coming back into the market. So and also high loan to value deals started disappearing. So, 80% loan to values, 85% loan to value deals started disappearing. Funny enough, Vida Home Loans, one of the lenders, has come back in last week with an 85% product. Now, I don't recommend going for anything above 75% for my clients anyway, because I just think the deals are not that great. They're not very competitive. We've also seen, as of all the tax changes, a massive shift towards limited companies. So we've got different types of clients. So we've got some clients that have got some in their personal names, but their future properties are all being bought on a limited company basis. And then we've got a whole batch of clients that have got portfolios, and what they're doing is they've sought tax advice, and then they are now moving that into a limited company structure. And that could have all different shapes and forms. So some tax advisors are recommending you put it into an LLP, and then maybe trade for a couple of years and then flip it into a limited company. Others are doing it in a different way. What I would say is whenever I speak to my clients and say, look, go and speak to a tax advisor because you really need some advice, they come back to me with a different thing. Okay. So I don't trust any of these tax advisors, to be honest with you. Okay. Because whenever you speak to somebody, I hear something else. So we normally just say, look, go and speak to a tax advisor. They know the rules around, they know your structure, your property, and your goals. You know, what are you looking to do? Are you looking to add to the portfolio? Are you thinking of winding it down? How much is your gearing? Then obviously there's a plan, and I saw there was an estate planning there. There's an estate planning side of things as well when you're dealing with portfolio. So we're coming across a lot of that. Okay. Now, whether that's big portfolios that we're putting into a commercial vehicle. So when you're dealing with a larger portfolios or higher value portfolios, that opens you up to maybe putting the whole thing with one lender, one commercial lender. Okay. The good points around that is you've got one mortgage essentially. Also, from a rates are relatively keenly priced, but you've got to have very low gearing. Okay. So I would say a typical commercial transaction on a portfolio is under 50% loan to value. Okay. On portfolio, if it's going to go to Lloyd's, for example, and people like that, Lloyd's banking group, they will want very low gearing on things. Now, that goes against what many landlords generally do, which is historically have done, which is stack them high because of the mortgage interest relief. And obviously you're offsetting a lot of the costs. You're taking that money out to maybe invest in other properties. Okay. So it just depends on where you are in the journey. You see, I've got people that are a little bit older. They've got their portfolio. I don't think they're going to add to it. So they're looking at more efficient ways of dealing with that portfolio. Or then you've got some of the younger guys that are, you know, looking to buy some more, add to assets, and they're going to a different strategy. And generally they're going with individual lenders, 75% loan to value and so forth. Another change that's happened, and that's not so recent, and that's following the PRA rules, which is essentially has affected rental calculations. Now, I don't know if you guys are predominantly London-based, but within London, what's that's done to the market is it's really pushed everything to the 5-year market. So because everybody would want to borrow as much as they can on a property, they want to gear it as much as they can. What's happened is if you go for a 2-year fixed, you're generally not being allowed to borrow as much rather than a 5-year fixed. So what that's done is pushing all the landlords into a 5-year fixed environment. Now, it's got some good points and it's got some really bad points within this. First of all, the good points is, look, one of the biggest issues with mortgages at the moment, especially in a limited company environment, is not necessarily the rates, but the fees. Okay, the fees are expensive. Okay, so you know you might get a 3.5% interest. Okay, but it might have a 1.5% fee on there. And if you're talking about a 700k mortgage or 500k mortgage, you're looking at 10, 12,000 pounds just for the pleasure of that lender lending you the money. Okay, so there are, and so some people are saying, look, if I'm having to swallow that fee, I'll just kick that to a 5-year fix because I don't have the running cost of doing another remortgage in 2 years' time, which makes sense, unless you need some access to capital. Now, there are some great products out there that are maybe 5-year fixed, but have got a 3-year tie-in. Okay, so don't just go with a 5-year fixed. There may be options available for you. Because I think for portfolio, you need to have access to capital somewhere down the line. You don't know what's around the corner. And we were just talking about, you know, payment holidays, cash flows. So don't be tempted just to put everything on a 5-year fix because it makes sense. Now, maybe keep 1 or 2 in a 2 years, maybe have a flexible product. I'll give you an example. Godiva, Coventry, on a individual name basis, okay, on a buy-to-let product, they've got a 5-year fixed with no early repayment charge on a buy-to-let, which is fantastic, at like 2%, 2.25 or something like that. So there are some products out there that will not pigeonhole you and get you stuck into a product for a long term. So we've seen a lot of flexibility around that. And the expat market, I know we had an expat question. The expat market is actually quite buoyant back as well. We've seen a lot of people investing, live in Hong Kong, Qatar, Dubai, various countries. As long as it's not seen as a high risk country, we're seeing a lot of them investing in UK property. There are some caveats with lenders. Some lenders would say, if you are an expat, you need to buy it in a limited company structure here. And others will say, no, you can buy it in personal names or limited company, and you don't have to be a landlord, essentially, with some of them. So that sort of goes through the criteria changes and some of the pricing out there. Now, I have got some examples, and I don't know if you can give me access to to the screen. I've got some examples of what a typical, I don't know, a buy-to-let deal looks like. Or a HMO deal, but fundamentally at the moment, what you're seeing is it's not really about the rate. It's all about the fee. It's all about the fee when it comes to specifically HMO products. We've also seen a separation of HMO itself. So up to 6 properties is almost as up to 6 rooms is seen as a small HMO. Anything beyond that is seen as a larger HMO, up to 20 bedrooms, 25 bedrooms. So different lenders have got different appetite for that. And you've got to have a level of experience as well to be able to be considered a HMO landlord. So a lot of lenders want 1 or 2 years buy-to-let experience. Some would want specific HMO experience. So if you've got a buy-to-let, and I don't know, you're dealing with Kingdom to turn that into a HMO, there are some restrictions around that. And I don't know, are you doing a lot of conversion? Is that done, David, before it comes to you?
With regards to?
With regards to landlords who've got buy-to-lets and now they're looking to turn them into HMOs. Do you do many of those?
You know, frankly, the process usually goes the reverse.
Beforehand to you. Yeah.
It's already a buy-to-let, not for a HMO. And then when it comes to renewal, that's when they go for the HMO mortgage.
Yeah. So from a HMO mortgage perspective, right. So let's talk about that, because what you've got is there's a lot of licensing changes at the moment. Lenders have been a lot more strict with HMOs now, valuers, when they're sending the valuers around. And what I'm seeing a lot on HMOs is, we'll talk about the EPC side, which is really important. You've made some good points on that, and I've got some experience of that. In fact, if you type in buy-to-let mortgage with low EPC, I think we're like #1 on Google. So I get a lot of low EPC type transactions, and I'll talk to you about how that works. But in terms of the HMO process, there are a lot of lenders where they will say, look, as long as you can prove that you've applied for the HMO license, we will allow to process the application, and then on completion you need to have that license in place. So just because you don't have a license right now, there are lenders that will say, right, okay, so if you're doing a purchase and it doesn't have one, you could apply for it. So that could help some clients, and we do have them. In terms of low EPCs, basically, if they've got an F, they can't get a mortgage, okay? They can get away with an E right now. And it comes down to what it actually says on the EPC. But if it's generally, it needs a new boiler, okay? And different lenders have got different limits. So I've got a lender that will say, if it takes more than £2,000 worth of work, then we're going to do a retention. Basically, we're not going to do it until that work is done. I've got another lender who will say, if it's going to be a couple of £1,000 worth of work, what we will do is we'll lend on it, as long as the surveyor can confirm it's going to be £3,000, £4,000, £5,000. We will then do another survey 3 months after completion. So that's great, because that basically enables you to buy the property and avoid going down the bridging finance route or light refurbishment product, which can be very, very costly. So I'm doing a number of those whereby landlords are looking to buy properties that are on an EPC of F, and they can get a good deal on, because most other landlords will stay away from that transaction, and they're using us for that type of facility. And that could be done on a limited company as well as individual basis. So that's on the EPC front. Let's talk about payment holidays, because it's very, very painful subject for a broker. And that's because lenders are afraid of people that have taken payment holidays, okay? Basically the rule is, and just before this call, actually, I had another landlord who said, Payam, I'm looking to buy a new property, but I've taken a payment holiday. It's going to finish in October. I think they all finish in October, quite a few of them, because of the time frame. And he said, what do I do? Basically, the rule is the lenders want you, they want to see two things. You've taken the payment holiday and it's come to an end, and you were not in distress. Okay, so that's the two things you have to prove to the lender. You took it because you could, essentially, but you didn't take it because your business was going under and you were in distress and you were going to default on lots of things. Okay, and there are variations of there is varied ways of how you prove that to them. So they may be able to see it through your bank statements. They may be able to see it through your credit report if you're stacked up to the hill there. But generally, what they will ask for you is, have you had any government support? And around the payment holidays, I've done probably about 4 or 5 cases now, various criterias where they've taken a payment holiday and it's got through. It's not a problem, but we've had to just prove that the client, whether they were furloughed themselves, they took the payment holiday, whether their tenant was furloughed or lost their job and they took a payment holiday. But what we've had to do in all cases is prove to them that it's done. Now, some lenders have got different rules. Some lenders, if you own under 4 properties, so you're not classed as a portfolio landlord, will deem you to be higher risk and they may not even do it. Others will say, no, that's fine. As long as it's been dealt with, we will do the new loan. It's not an issue. So make sure you disclose that to your broker if you're ever dealing with us, that's really, really important. The second bit that they are afraid of, and honestly, and I'll give you some examples, is bounce back loans. Okay, so those of you who have taken bounce back loans, the lenders want to know that, and this is really important, that no part of that bounce back loan is being used for a deposit for your new property. Okay, now how do you do that? Generally, what they want to see is, say you take £50,000 bounce back loan, they want to see that you had £50,000 in your account. So you're using the bounce back loan for something else. You're not using it for the property. Okay, and that's important. I've got lots and lots of deals right now where we are back and forth with the lending underwriter, proving this bank statement, proving that bank statement, and it's just an absolute nightmare. So bounce back loans, the lenders want to see that you're not using them for deposits. And overall service is horrendous. You know, I'll be honest with you, in terms of getting cases or remortgages done quickly or purchases done quickly, the lenders haven't coped very well because everyone's working from home, manual underwriting, these additional questions that they're asking, whether it's to do with payment holiday, bank loan, they are not coping very well and it's taking a lot longer. I'll give you an example. I've got a chap who's got 13 properties, been with me for a number of years. He's got 13 properties, came to me and said, he's a little bit older, and he said to me, Payam, I've got one of my deals is going to run out. Okay, my term is running out. Okay, can you remortgage me? Like for like remortgage. I don't want it anymore. I don't want a capital raise. I'm not doing debt consolidation. Can you just give me a like for like remortgage? 1.5 months later, I'm still answering questions by the underwriter because he did take a bounce back loan. I think he took a bounce back loan, but it was basically, it's back and forth around his job, around his sick portfolio, around rental voids, everything. And it's honestly a 1.5 month later, we are still dealing on a like for like remortgage. Okay. However, we have also seen some huge opportunities in regards to properties where a lot in the Midlands, I have to say, a lot of HMO deals that are being done there, whereby people are buying properties, doing them up, whether they're converting them into HMOs, whether they're adding extensions and so forth. I've seen huge movements within that. We got into a lot of development, whether it's under promoted development. There's a lot of opportunities being done around that in terms of auction finance. So landlords are looking at not only HMO and your normal buy-to-let, but also trying to make money on the purchase and conversion. So a lot of deals are being done on that basis. What else have we got here? So let me just go through.
Payam, I think I made you a co-host, so I think you can share your screen. I don't know if you can have a look.
Let me have a look. So how do I share my screen? Security. Oh, share screen. There we go. And let's go here. Let's share. That's all my videos, but let's just go. Can you see my screen, guys?
Yep.
You can see this. You can see this. Yeah. Okay, fine. So let's go through and let's look at, oh, we've got to get rid of this thing here. Right. So this
at
is
the moment you're sharing your videos with us.
Oh, I'm sharing my videos. That's no good.
I mean, they look fun.
Yes.
Good looking guy. But
Thank
we probably
you.
want to see the numbers.
Yes, exactly. So let's go through. There we go. Share. Is that better?
That's it. Yeah.
Okay. So let's have a look at a typical buy-to-let. Do you want me to do a buy-to-let quote or do you want me to do a HMO quote? What would you prefer, guys?
HMO.
HMO?
Yeah, HMO. No.
Okay, fine. So let's go through here. Client HMO mortgage. Okay. So let's put a typical client in. Let's put in, I don't know, £700,000 purchase. Would you think, what would you want to do? Let me know what sort of price you would want that on there. I'll work it on 700 for now. And let's say we're trying to do 75% loan to value, which is 525,000. Let's do a 25-year. Let's do an interest only. Let's do sale of property for the mortgage. I'm not going to put the rental in there for now. And for this example, I'm just going to say, do a 5-year fix for us. Okay. So 5-year fix. And let's have a look at those. And this is a purchase. So what I'm going to do here is I'm going to do it on a true cost. I've done it on a true cost, which means basically over the 5 years, give me the best rate over the 5 years, including any fees that are out there. So the product, the fees, and the rate. Okay. So let's have a look and see why the 3.99 is the better rate. You've got a 3.99 here, which is an exclusive product. So we've got here, and then you've got Paragon. So you've got Fleet Mortgages, you've got Paragon Bank. Now, why are these rates so big? It's basically because I think the rental calculation is quite harsh on the amount you need to borrow. But in this example, we look at the 3.99 deal. It's more expensive than the second product, which is with Paragon, 3.74. But if you look at it here, overall, over the 5 years, okay, it's going to be cheaper, okay? So on true cost is 106. Bear with me. Let's just do true cost. Here we go. So sorry, true cost, Paragon Banking Group. You got number one, 3.74. True cost is 1,092. And then you got the mortgage lender, that. So let's have a look at the fees. The fees alone on this is £11,000. Okay. Now you can add it onto the mortgage, or you could then decide to go for a 3.79 with a mortgage lender. That's got a £4,000 fee. And then if you look at it, the various lenders have got various products. So the mortgage lender, very same lender, has got another product with £14,000 fee. Now this is over 5 years fixed, and it just gives you an idea. So why would we as a broker not maybe go for this one and maybe go for this one, or maybe go with a different lender? It could be the fees and the rates and so forth. It could be, and more importantly, generally when it comes to a lot of professional landlords, is how they assess background portfolios. And that's probably the most important part of new mortgages now that we have to deal with. If you own more than 4 buy-to-lets, you're classed as a portfolio landlord, which means all of these lenders will not only assess you on the 5-year fix that you're going to take out, but they're also going to assess the background portfolio at a stress rate. Now that stress rate is very much dependent on the lending criteria. with some lenders, the loan to value of the overall portfolio. Okay, so if you have got a bad performing portfolio in the background, or it's highly geared, some of these lenders may not be the right lender for you. So it's not just about, you know, in the olden days, you could literally just go, give me the best 2 year or give me the best 5 year, and whoever was at the top, and you do it. Okay, it could be around HMO criteria and the number of bedrooms they will do. It could be around unlicensed HMOs that, you know, they don't need a license, but they're called multiple occupancy products, what their criteria are around that. And also, you know, some of them, like I said, have got better stress testing than others. Okay. I always like to take things into account when I look at a deal, also around early repayment charges. What type of early repayment charges have they got? So we've got, as brokers, we've got access to quite a lot of information here in regards to the property, exit fees, any other cost involved. Do they want, if you're buying in a limited company, do they want dual representation? Can they do dual representation, for example? Or do they want personal guarantees sometimes? So in most cases they would. So, you know, buy to let in a limited company, it's really for the name limited company. Otherwise, it's individually underwritten on yourself. It could be your age. For example, some lenders will go up to the age of 110 years. Others don't have a age limit. Okay, so it may be the rental calculation. So there are many reasons why you would go to one lender and not the other lender. History. So history around underwriting. So I've done, let's just have a look. I've done a mortgage with every single one of these lenders in the last 30 days. Okay. Not sure about Marshaven actually, but all of those. And I could tell you from their criteria and from their underwriting process, one of them could take 3 weeks to get a valuation booked. Okay. So if you're looking to go and for a property, you might be going for the cheapest one out there, but if they're going to take 3 weeks to book a valuation, you're going to lose that property. Okay. So it's not just about, you know, whether it's 3.79 or 3.85, it's about doing the deal and having the relevant and up-to-date information on the lender. Vito went out of the market and they've come back into the market. They've changed their entire range. Their criteria has changed. Many of the other, I mean, there are, let's go down some of the, I mean, some of these lenders here, I don't know if you've heard of them. Zephyr Home Loans, that's a new lender. Landbay, these are all specialist lenders. And we are, as an independent brokers, we've got access to the whole of the market. So we deal with, there are a few that we don't deal with out there because of maybe they've got a closed circle of distribution, but we've got access to over 80 lenders, and most of the specialist lenders are out there. So let's have a look at what else have we got here in terms of it. We've gone through bounce back loans, growth sectors. Really, the growth sector that I'm seeing is around conversions. They're converting properties. A lot of what I'm doing at the moment is a lot of blocks that have been converted into self-contained units. Okay, so applicants buying a block of flats. It's got 4 flats or a whole block, converting them into different titles, putting them in separate flats and letting them out individually. Now, there are rules around that, because a lot of lenders will only allow you, if you've got 4 in a block, they'll only take 1 of the flats. So you've got to literally, either you give the whole block to one lender, or you have to split them up. If you want to have individual lenders, so you have to split them up. They'll only do one, they'll do 25% of the block essentially as rules. I'm seeing a lot of those type of transactions. A lot of, the last one we did was a care home being converted into 7 units. So we did that. That had to be done by bridging finance, and we're doing a lot more bridging finance now. A lot of ground up developments as well we're seeing, where they've owned land and they're building actual units there and then. So
Payam,
yes.
Would you rerun this for me on a 1.2 million property value with a 30%
let's go and have a look at it. Yep. Okay.
While you're doing that, Payam, can I just jump in with a quick question?
Of course.
I've only got one simple mortgage that I want to remortgage in the next few weeks.
Yep.
The existing lenders come back to me with a sub 2%. I think it's a discount off their standard rate for the next 3 years.
Yeah, that sounds like a building society out there. Yeah.
It is a building society,
Yeah.
yeah.
I know it.
Mansfield. That's with Mansfield. It's actually
Yes.
secured on my own house, but I use the funds that I generated from that to refurb the house that Dawid manages.
Right.
The reason I'm drawn to it is because no broker fees, no revaluation, all the rest of it. It's a really easy deal. And whilst I might be able to, I think it's like 1.45 or something like that. So it seemed to me like it was in the
That's
right
a residential deal, sorry. Is that a
Yeah.
residential mortgage?
That's a residential deal, yeah. So
Okay.
it seemed to me like it wasn't really worth me going to the market to have a faff around. And particularly now listening to what you've highlighted, my takeaways from the call were A, a lot of hassle factor at the moment in the market, and B, a shed load of fees that would be coming my way to do, which I've done. I've been doing it, every 3 or 4 years when it comes to the end of its fixed term. It doesn't seem like it's worth trying to sweat it much below that. If I got something like 1.45, I'm not going to do much better than that, am I?
No, I will listen. One of the key things we do with our clients, we'll be honest and upfront with you guys and say, look, what are you trying to do? So in your case, you've got a residential that's got asset. The problem is for a lot of people, they may not have the affordability to the affordability check on a residential. So you've obviously got the income to prove that you can borrow what you can borrow, okay, on your residential. A lot of people do not want that level of debt on their own residentials, okay? So they're not comfortable with taking on that level of debt. If you're taking that debt and they're happy with you to invest that into a buy-to-let property, that's a good deal. Have you got an early repayment charge on that? Those building societies have got early repayment charges on those type of deals. So you just got to be
they do. You can only do 10% a year, and then. So I could, on the changeover now, when it's a remortgage, I could change it obviously because it would become. I get a 5-day window to do a bigger adjustment.
What I would say is I was really specifically concentrating on HMO and limited company type transactions. When you're dealing with residential mortgages, which you do a lot of, things are completely different. Okay, they're actually a lot more quicker because it's almost like a factory setup when you deal with residentials. So as long as you've got the proof of ID, proof of address, what are you using the funds for? We're actually getting really, really good. And that's a lot more automated. So the valuations are getting straight away instructed. So I don't know, what rate did you say you had on the residential? What is the rate?
I think it's something like 1.45, somewhere around there.
Yeah, that's not a bad rate in all honesty, in any circumstances. That's not bad. I would probably take that. And I would probably say, do you know what? If you're with them and you have to just flick a switch and go with that, take it. It because
that's helpful.
Thank
you very much for all the wisdom. I have started engaging filling in your forms, but I never got to the end of them.
Really? Okay. Yeah, they're quite long. We have to ask for so much more. It's not like the olden days. We have to ask for so much because we have to cover the bounce back loan. We have to cover your. So what we're trying to do is get everything up front. So when they start drip feeding questions to us, we've got the answers rather than come back to you and back and forth. So although it's painful, maybe for the first one, because we'll have your details, it becomes easier when you're dealing with the third and the fourth and the remortgages and so forth. Right. Okay. So let's go through.
I've got to say bye. Thank you very much, guys, Dawid and Payam, for organising this, and other landlords on the call. Appreciate that.
Take care, Stuart. Good to see you.
No problem. You take care. Bye-bye. Right, guys. So are we doing 1.2 million? And okay, so let's not put the rental in there for now. It should be okay.
840,000 is the loan, so it's a 30%.
Oh, sorry. How much?
840. And it is a buy-to-let. I don't know if that matters for it's a HMO.
It's fine.
The drop down.
That's fine. So let's go and put that in there. We've put the marker in there, HMO.
Does it make a difference if we put the rental income?
It will do funny things with the lenders. Okay, so various lenders. Give me the rental. Let's put it in, and then we can play around. 5,500 per month. Okay.
Yeah.
Okay, good. So let's run that. Okay, and let me see if I can move this. That's it. And let's do true cost. And I'm going to do the true cost over 60 months, which is 5 years. So look, Barclays, they don't do HMO, so that's wrong. Okay.
Yeah.
So what you'll see there, Paragon's coming back. Now, Paragon, very keenly priced lender, been on the market for yonks. Horrible to deal with in terms of underwriting. Okay. But they are generally very, very good. They're generally very, very good on their affordability, on their rates. So it's coming in. So it's going to be £2,456. initial interest for the next 5 years. After that, it will go on the standard variable rate, which will revert to 2,998. But in all reality, we will probably remortgage you off. Now, it's important, just because I've put that in and just because this has come up, it doesn't necessarily mean that that's achievable. I've then got to go and do a rental calculation checkup on the Paragon website specifically about that client because we need to find out. Now, let me have a look here whether this was in a limited company or whether it was an individual. So no, so this wasn't in a limited company. This was just individual. Did you want it in a limited company?
Yeah. Otherwise, the interest rate relief is going to kill the buyer.
So let's have a look and see if that made a difference on the deal. It hasn't. It's the same deal. Okay, so that's available to both. Okay, so those are the two lenders. In this instance, they're coming up. But you know, you can have various options. Now they've got Paragon's quite funny because essentially, in theory, they don't do background stress testing, but they do. And they will do it. If you're heavily indebted, it will have an impact on things. They've got a minimum income of, I think, £25,000. And I think you need to be an owner-occupier or at least own one property. So that gives you an idea of what's available. Some of these are exclusives. Some of these are available. So something like this, what we will do is we'd always come back to you, would give you a quote, and we'll run off an illustration. So evidence of research, let's go and have a look at it. And then this will give you, I'm just going to put the fees on. So these are some of the fees that are around, but I'm just going to attach it. And we'll send you always a KFI. Let's move this. We'll always send you a KFI or a mortgage illustration similar to this. You've all probably seen this by now. And it will just generate it. We'll send that off to you guys in a company. And this will really break down, the mortgage illustration basically breaks down everything, who we are. And then the most important thing, it breaks down the fees itself. So on all buy-to-let mortgages, from our perspective, for the sake of transparency, we charge £499. It's not payable until completion of the mortgage. So that's it. If you don't get the deal, you lose the property or something goes wrong, you change your mind, you don't pay us. And when the deal goes through, it's £499, including VAT. So it's a flat fee structure we deal with. I think that's quite transparent when you're dealing with clients. We used to do percentage of loans and stuff. And unless you've got adverse credit, it's going to be probably the same structure. So it sort of gives you an idea. Here we go. There's our broker fee there. And then it gives you the various other fees in that. Application fees, chaps fees, and the usual sort of stuff. And, you know, more importantly, always look at things like with some mortgages, most mortgages, to get the chap mentioned, you can pay up to 10% with no early repayment charges. Okay. Well, in this case, I don't think they do. I don't think they allow you, if you go for an interest only, to pay off that mortgage within that period. Okay. And more importantly, always look, when you're looking at the illustrations, always look at section 8, which is about the early repayment charges of when you can get out. So in this one, it's basically 3% after the 2 years, right the way through to year 5. Additional obligations, portability. So all of these things is really worth, and this comes with free valuation, which is really, really good. But
so, Payam, talking about those early termination fees, I mean, they're quite massive on this mortgage. Granted, it's a big mortgage, but if you were in distress and had to sell, yeah, that's another 35K.
Massive. Yeah.
Knock.
Exactly. And
you pay the estate agent, you pay this, you pay that.
Yeah, absolutely. And that's why when I say, you know, don't just look at the initial rate, look at the product flexibility and communicate with your broker, whether it's myself or whether it's your own broker, communicate over the strategy of your portfolio. Don't just go for the cheapest just because it's the cheapest right now. It's got the lowest fee right now. Look at the flexibility, maybe put one or two on something like this, which is the best rate. So that will be good for your cash flow, but maybe put one on that's got a less early repayment. So let's go and have a look at another deal.
I mean, talking about communication, if I was comfortable of the opinion that the interest rates are not going to get increased by the Bank of England, you know, why not just take a tracker rate? Is that not something that one can do? Or
Right.
why not look at a
Good question.
10-year fixed rate? Because these rates that change, doing this every 5 years, if 5 years goes quickly.
Yes. Well, there's not many 10-year fixes, and it goes back to my point of how these lenders are funded. Okay. If we look at this page in the top, I don't know, top 10 page, right? So Paragon is a bank, so they're funded, so they get funding from the government. Okay, so they've got access to cheap funds. Surprise, surprise, that's why they're up there. Okay, mortgage lender securitizes. Okay, Vida securitizes. Okay, if we go to next page, Zephyr securitizes. Marstaven is a bank, so they've got access to cheap funds. So it really depends. They don't want to be tied up with that money for 10 years. So that's why the maximum a lot of them are offering is a 5-year deal. In regards to trackers, it's a very good point. Let's have a look. I just did a 5-year fix. Let me just put all products, okay? Let's move this again here and apply filters. Okay, true cost. So let's go and put the filters in there. We put the apply filters. So this is all the products that are out there, trackers, all sorts of products, okay? If you look at it, it hasn't made too much of a difference. There's still the top 2 out there, okay? Now, there are some of these are LIBOR trackers. Here we go. The rest of them are all fixed. They're just not that competitive because of the way they're funded. And also with trackers, I'll give you an example. Kent Reliance used to have a fantastic product. I don't know if it's still around. They've still got a tracker deal. Clients were using the tracker deal because they didn't want an early repayment charge. Maybe they were going to do up the property and refinance later. Maybe they were buying the property and looking to turn it into a HMO or something. The way lenders treat the rental calculation, remember I talked about a 2-year and a 5-year fixed? They will treat the tracker just like a 2-year fixed. So they're not allowing you to borrow as much on a tracker than a fixed rate product. And that's why many lenders are many clients are opting for a fixed 5 years, but rather than a tracker.
On this screen here, that the 2 LIBOR rates that you have open.
Yeah.
I mean, if one person, if you're keen on saying, you know what, 3.66%, I'm okay with that.
Yeah.
I don't think the rates are really going to increase.
Yeah.
And I don't want to remortgage. I mean, that one is a full term, so you could take out that mortgage.
Let's have a look at it. Let's have a look at the fees on that, okay?
For the full 25 years.
Look at the fee, okay? They're taking the fee up front, basically, okay? Yeah. So that fee's quite expensive compared to that one, maybe, all right? So, but let's have a look at this, okay? Let's go through it, and I will tell you so this is Lambay, okay? So again, another lender that's looking to securitize. I'm just going to move our screen again because I cannot access. There we go. Generate illustration. Let's look at the early repayment charge section on that product. So absolutely. So the way they'll treat the rental calculation, the likelihood is I would probably guess that 100% probably certain that you're not going to be able to borrow the money that you need. Okay. Because of the way they do their rental calculation. But if we go to section 8, and that's what I mean, when you get this stuff, have a look at it. Section 8, basically there's only £100 redemption penalty on it. So we used that product for a client. I had a client, he bought the property on bridging finance, did a lot of work to it. I mean, I think he bought the property for 600K, 700K. It was worth 1.2 by the end of it. But he wasn't sure whether he was going to keep it or sell it long term. And he said to me, look, Payam, I don't really want to get tied into a massive deal because I might at the moment COVID's happening and stuff, and I know there's going to be problems. I might rent it for 6 months to a year, but then I might want to sell, okay, and take my money out. So I recommended in this product, okay, because I said, as long as the problem was he wanted to take some money out, he couldn't, but we still recommended in this product because it was better if it just meant that he couldn't take as much money out. But we did a remortgage on that basis with this lender. And this lender could do a remortgage within 6 months. Okay, so that's where tracker rates come in quite handy, because of if you want to look to sell it or change use somewhere down the line, you don't want to be tied in. Unless otherwise, because of the huge fees, you might as well pay the 5-year fixed and go down that route. Okay. Let's have a look and see if there's anything else here that we were going to. So over 60, so I mentioned a lot of lenders now have loosened their criteria around age. So, you know, we've got lenders that will lend regularly up to the age of 80 to 85. And we've got a few that don't have an age limit. So that's not a problem. If it's within a limited company structure, a lot of people are adding their children on there. As long as there is a progression sort of there, lenders will take a view around things like that. Again, we talked about buying abroad, bounce back loans we talked about. So anything else, guys, you want me to answer? Any questions specifically?
Hey, Payam, I've got a few actually. Well, it sounds obvious, but what is a bounce back loan?
Right. Yeah, okay, fair enough. That is, so bounce back loan is the government said to businesses, and properties can be seen as businesses, okay, that they can take out a loan or interest free for the first year. And then after that, I think it's 2% interest. You can take a bounce back loan. So a lot of businesses took out loans, and it's to do with your turnover. So whatever your last year's turnover was, you can take up to a maximum of £50,000, a bounce back loan. So a lot of landlords that have got limited company transactions and so forth, they took out these loans, okay, because they were eligible for them.
Sure.
So all of a sudden you got 50K coming in, okay? Those loans were really for businesses to continue and be able to be viable. That was the main reason why the government gave this loans. But obviously, if you go through Google and you go to YouTube, lots of property gurus as such were telling people to take these, and you know, you might be able to do something with them. Now, yeah. I'm not saying they're a wrong thing to do. I think they're actually quite a good thing to have. However, you can't use them for buying properties.
Yeah, that makes sense.
You could use them for doing up properties or keeping your business afloat, okay? But using them as source of deposit is the problem, okay? Sure. So there, you know, they talked about. I think 3.5 billion bounce back loans have been taken where they shouldn't have, but it's still available. I'm not sure if they're still available or not, but a lot of the businesses and a lot of people that are self-employed have taken them.
No, that makes sense. Second question. Quite a lot of brokers, they don't charge any money. Yeah. And, you know, when I bought my house on a residential basis, the broker said that the mortgage provider was paying for his fees. Yeah. So why is it that you charge or some do and some don't?
Okay, that's a very good point. I've done a video on this topic as well. So basically what you've got is you've got different types of brokers with different types of skill set, okay? There are the big supermarkets. So I would say, you know, there are brokerages out there that have got 200-300 staff, okay? And they will not charge any broker fees, okay? However, it all comes down to the lack of the experience and the process that you will get from a lot of the different brokers. So we charge a £499 broker fee. It's not payable until completion. Others don't charge a fee. There are some central London brokers that will charge 0.5%, 1% of the loan amount, okay? What we all can say is, look, every business is different, okay? It's not just about the rate and the paperwork. It's about getting the mortgage, okay? Now, I can understand if it's a very straightforward deal and you're doing a residential deal and what's your income, what's your affordability, what you're doing. Some of these buy-to-let deals that we're doing with portfolios behind the scenes, with HMO lending behind the scenes, they will take a lot of work and a lot of expertise to get those through, especially in this environment. And most of the deals that I get are secondhand. So what I mean by that is they've gone to the bank or they've gone to another broker. And most of them have gone to brokers that don't charge a fee, because essentially you get what you pay for. and that's where a lot of them have gone to lenders where I had one today, went to a bank where wanted to do a remortgage within 6 months, bought the property cash, wanted to remortgage within 6 months. 1.5 months later, he was declined. And he phoned me up and he said, this is the lender I've gone to. Well, I said, well, they don't allow you to remortgage within 6 months because you've bought it cash. You can do it on bridging finance. So 1.5 months later, he's been back and forth with paperwork, and all it was is the lending criteria didn't fit. So it just comes down to level of expertise.
That makes sense. Okay. And the last question. So in this example that you've run for David for the 1.2 million property,
Yes.
I think David said that that was a buy-to-let property. So what are your thoughts on getting a buy-to-let mortgage or a residential mortgage for a HMO business?
What's my thoughts on getting a buy-to-let mortgage or a residential mortgage for HMO?
And using it for a HMO.
Right, okay. So what you mean is doing a residential mortgage, getting your money on the residential and then investing that into a HMO?
No, I mean, if you've got an existing residential or buy-to-let property,
Yeah.
turning that into a licensed HMO.
We do that a lot. So it comes down, it's called a let to buy if it's a residential, okay? So it becomes a let to buy. So it's a little bit different around that because it's seen as a consumer buy-to-let transaction. There's different regulatory permissions needed to do that transaction. So if you are saying, I am going to move out of my property and I'm going to convert that into a HMO, okay? Lenders have got rules. Some lenders will say, you need to buy another property simultaneously as you're moving out and capital raising, okay? If you are going to say, I'm going to turn this into a buy-to-let HMO, and then I'm going to go and move in with family, or I'm going to rent, other lenders have got criteria. But I would say 95% of the lenders will not give you a mortgage if you're not buying at the same time, okay? In terms of whether they'll allow you to turn it into HMO, yes, they will. You will obviously need to have a HMO mortgage when you complete on the deal. So you can apply for a HMO permissions and so forth, but sometimes as part of the application process, the local authorities tend to write to the council and say, did you know, Santander, you've got a residential mortgage. Did you know that they're looking to turn this into an HMO? Santander will turn around and say, no, we don't give HMO mortgages. They'll write to you and say, look, if you're going to do this, you need to move. So it's tricky. We've dealt with a number of cases like this, but it's not straightforward to do.
Great, thanks.
Payam, can you share some of the cases, sort of some of what was the outcomes and what happened?
Or on that specific case,
yeah.
I've had a case whereby client in Clapham, it was a number of years ago now, client in Clapham was a residential property. He went to look to turn it into a, bear with me 1 second. I think I've got a call coming in. So 1 second. Apologies. Bear with me 1 second. Sorry.
Yeah, no worries. This tool that they use is very, very interesting. And I think that there's a lot of good points about these mortgages, especially considering can you exit early, you know, the fees, and also do you want to renew in 5 years and do the whole fees thing? I mean, I'm of the, I wish there were longer mortgages.
In terms of, so I had a guy who basically lived in a property in Clapham, came to me and said, right, he was with, funny enough, Santander. He was with Santander and he had converted that into a HMO, or he was going to let these rooms out. Applied for the HMO license. Santander wrote to him, said, you've got 30 days to move, basically. You're running a HMO, we're not happy, you've got a residential mortgage, you need to move. So we managed to place him with, because he was applied for his mortgage, I think at the time we managed to place him with, and this is going back a few years ago, with Leeds Building Society, who had a fantastic HMO product range. So and he had gone to 2 other brokers, and those brokers managed, one of them was trying to place him with a commercial deal. Another broker was unsuccessful with one of the lenders out there. We managed to get him a deal with Leeds Building Society, I can remember, a few years ago now. And that's it, really. It was a residential, and obviously he had moved out because he had bought, we did another mortgage for him, a residential mortgage. So this is really important around, if you're converting your residentials into a HMO, there are lots of different rules you need to be aware of. It's not as straightforward as buying a HMO and then just running as a business. A lot of these lenders will not be able to do consumer buy-to-let. What consumer buy-to-let is a property that you've lived at or a family member has lived at. A lot of them don't have permissions to deal with consumer buy-to-lets. So, and that's where the problem arises. If it's your own current residential home, it falls under the consumer buy-to-let rules, which a lot of lenders are not allowed to advise on or do that type of transaction. So in terms of other deals that we've got right now running, got a portfolio at the moment worth 13.5 million. Client is looking to raise 2.5 million on it. So we're going to a commercial bank. That he's trying to raise £1 million for a lease extension. We do a lot of lease extension stuff. So in London, central London specifically, what you've got is a lot of the properties out there have got short leases, and lenders are really funny around short leases. HMOs, we done one recently, HMO with on top of a shop. Absolute nightmare. Stay away from those if you can. Basically, it's a large flat, block of flats on top of shops. A lot of the lenders that deal with HMO lending tend not to do flats. So it's very difficult to try to place them with a reputable, decent lender with a good rate. We've come across a few of those. What else have we got? HMO on commercial dealing. So when you're dealing with larger HMOs, and I get this quite often, it's valuation, commercial valuations for HMOs rather than residential bricks and mortar valuation. If you've got HMOs of 15 bedrooms, 10, 15, 20 bedrooms, they can be valued in a commercial basis, which means essentially, if they had to be sold on, they can't be sold on as just houses anymore. They are essentially their own businesses. And there are advantages of going down that route, specifically around borrowing more and the value of the property. So we've had a few of those in the past. But generally, we get a lot of, portfolio landlords either looking to raise. What I'm getting at the moment, talking about the property market, is I've got a lot of clients right now who are remortgaging their properties, sitting tight, because I think they're waiting for the market to shift in London where they can buy. So because the mortgage offers are valid for 6 months often, people are just saying, look, I might need some money because I might want to buy. I'm not going to pull the trigger yet, but I want my mortgage to be done. So while I've got some time, I think it's going to, I think I'm going to buy probably next year, sometime early next year. So they're thinking about remortgaging now to pull some money together to get into the market when it's needed. There's a lot of that happening.
That actually makes sense. That does make sense, yeah.
And because we don't charge up front, and that's another thing, and that goes back to Anisha's question. Why would we essentially want to work with someone like that? Because we know the ins and outs of your business, and we work together as a team rather than I'm just you phone a broker up. One person's there this year, another person's there next time you call them, another person you deal with. I've essentially, because it's our own business, I would literally, David, I dealt with you how many years ago? And
you've helped me get all my mortgages, but
yes.
Yeah, it's been like 6 years or
exactly.
5
and
years.
You send me an email, and it will be me that will respond to you, and it will be me that will give you the research. So we understand your business, and I suppose what you're looking to do.
Fair enough. Yeah, that's true. In my case, Payam was chasing me for paperwork, and I'm like, can you just relax? I got lots of other things to do.
Yeah. No, there is a lot, but I don't want to give you this weird sort of, oh, everything's great and we're so good and we're so far. There are problems within the sector right now, and as long as you guys are aware of it, but there are some huge opportunities in the sector right now, because the key is if you've got properties right now, is maybe think about what you're going to do when the market does dip. It will dip eventually. When all this stuff is all over, it will take a dip.
All right. Well, I think unless anyone else has more questions, we're pretty much at the end of the session. There are some sources for the various news things that I mentioned in my seminar. If anybody has questions, either for Payam or myself, just make yourself known.
Yeah, it's Tim here. Hi, David. Hi, Payam. Thanks a lot for your information there. I just want your interesting filtering model. That's obviously your internal. Is your website, does that have that available for simple?
We do. We've got our own filtering sort of sourcing system. I'll be honest with you, they're not gonna be as thorough as the ones that we've got internal. And we've got that. There is a functionality where you can go and source. But what I mean by a lot of this stuff is a lot of this, the sourcing just gets you, I would say 60% there. The rest of it we've got to do. So every time I will send you a quote, I'll have to go onto the website, the lender's website, and run their criteria checks and run their calculation. Otherwise, and that's the difference, because a normal broker, what they will do is they'll go to that source and they'll just send you that source. But it's all dependent on the property types and all sorts of things. So yeah, but we do have that. We do have a source functionality. I've also, a lot of these topics, individual topics, I've got on my YouTube channel as well, where you can go and bore yourself and watch all of this stuff.
Okay, great. And just, I mean, those examples, they're all HMO examples. We were looking at David's example of a 1.2 500 mortgage. So really, current rates are around 3.7%. A number of those are without fees, but sometimes they are, and quite large fees, as you pointed out.
Yeah. I think the market on the HMO front is around between 3.5% to 4%. I think that's what you'll look to get on the HMO. There are. I mean, I did quote a client a 2.79. There is a 2.99. There are some HMOs out there, but they come in and out. You see, lenders at the moment, they're almost changing products on a weekly basis. So I'll do this source now, and it'll be one lender. By the time we've got your documents, I might have to swap the lender and come back to you and say, do you know what? We're now better off going with this lender.
Okay. All right. Thank you very much.
And one more thing. On normal buy-to-lets, I mean, on normal non-limited company buy-to-lets, rates are very, very cheap. I mean, I'm doing deals at 2% right now.
2% on normal buy-to-let. Okay.
Yeah. And I'm talking free valuation, free legals, you know, 999 fee or £1,500 fee. So on that side of things, because you got to remember, all the building society, a lot of the normal lenders, you know, your big banks, they're not playing within this field. Okay. So if they're only restricted to that side of the business. So that side of the business is very competitive because they've got access to cheap money. Okay.
Yeah.
And they're very competitive products out there on the standard buy-to-let.
Well, one of the filter was a bank, I don't think. I mean, you highlighted some specialist banks, but they weren't high street bank names.
No. It's because we've clicked the. I don't know can you still see my screen or is it gone? But it's because I clicked the limited company field. Okay, if I take that limited company off, your Barclays, your Santander, all of those, the Mortgage Works, BM. I bet most of you guys have got mortgages with BM Solutions, Mortgage Works. Some of those sort of specialist buy-to-let, maybe Santander, Barclays. All of those guys will come about, and there will be between, I don't know, under 2% to 2.25. That's where the market is. On individual buy-to-let products, really competitive.
Okay, good to know. Thank you.
Okay.
That's all for me. Thank you, David.
Thank you so much.
Bye.
Just one more for me.
Yeah.
When trying to get a HMO mortgage,
yeah,
how much does the rental income play a part?
Massively.
Okay. And do they typically look at 3 months or 6 months, you know, in the form of a bank statement? What are they looking at?
Right, okay. So are you talking about a purchase or a remortgage? Okay.
No, a remortgage to a HMO.
Okay, so remortgage, what they will look at is they will look at your tenancy agreement, okay? And they will look at your bank statements for the last couple of months, normally 3 months, you're right. However, doesn't matter. Even let's just say you're getting £700 a room, okay? Let's just say £500 a room, okay? Let's just say. If the surveyor goes there and says it's worth 400, even if you're getting 500, they'll go by the 400 value figure.
Right.
So they would want to see evidence of an AST and the rental by bank statements. However, final word is the valuer, the surveyor.
Okay. I mean, a lot of the guys here, David's the man, and I wish he would give me 700 quid a month for my rooms, but he takes a little bit off of me.
Yeah.
For his great services.
So they'll work on a gross basis. They'll work on a gross basis. So they tend not to take his fees into account.
No, but the point is that I don't have a AST per room, right? I have one agreement in place with David.
Management company, yeah.
Yeah. So sorry, that does work with the management company as well then.
Yeah.
Right. Okay.
Yeah. So what they can do is obviously, depending on the type of the structure, depending on the lender, some lenders will not accept management companies. Other lenders will accept management companies. Some lenders would say, we want you to have a direct arrangement with the tenants.
Okay.
Okay.
Anish, we've had to do that in the past to help vendors get it through the door, is transition our arrangement to a direct arrangement.
Absolutely.
With the side agreement on a fee. So those things can be worked around. It's just
very
extra
important
admin.
actually, that part, because a lot of the lenders, what they will say, this is really, it comes across when you're dealing with DSS sector, okay? When you're dealing with councils, okay? There are a number of agencies, what they will do is they'll do an agreement with you, and then they can put anybody in there. They can put asylum seekers in there. They can put all sorts of vulnerable people in there. And the lenders have got various criteria around that. Okay. That's why some lenders would want that direct arrangement with the tenant on an AST, because they want to see the AST. Some lenders will accept management company managing it, or property company managing it.
Thanks, Payam. Appreciate all the answers.
No problem at all. Are we good? That's it?
Sorry, one last question.
Go on, Tim.
You gave an example on 75% LTV. How much in general, would you say the HMO lending rate changes if it's 50%, for instance?
Good question. I think there are a couple of products at 60 to 65. Okay. Under 60, there's not much difference.
Okay, so it's down to 75, 60. And it might make a percentage difference or 0.5%?
Yeah, about 0.5%. It's not a huge amount. It's in their interest, bearing in mind how they're funded. Okay. It's in their interest to give it to you at a higher rate. Right. So
but then, and also that was an interest only example. If you do capital repayment, obviously it's a much bigger chunk, but how does that affect the rate on an HMO?
Doesn't make any difference.
Okay. So
whether you go interest only or repayment, it doesn't make any difference on a rate.
Interest rate money, the return on their interest capital.
So it doesn't make, so hence a lot of the deals that we get, if they are professional landlords, they tend to go on an interest only basis. Also, you've got to remember, some lenders, if you go for a repayment, and from a regulatory perspective and from my broker hat on, I should always tell clients, look, go for a repayment because you're paying that debt off. Okay. However, from a looking ahead, if you look to buy another property and they'll go, what's your yield on this property? And you go, well, I get £5,000 rent, but I'm paying 4,080 mortgage. They'll go, well, there's not much profit there for you. Okay. So, which is counterproductive. They shouldn't be doing that because you're essentially paying that debt off. But there are some lenders that will look at it and go, there's no income out of that, which is madness, because the incentive is for you to pay that off. We want you to pay that off. You should be paying your mortgages off rather than kicking it down the line. But
they don't really want that, is the truth, because they want to get the interest.
Get you back in 5 years' time.
Interest margin through bank LIBOR versus the rate they're charging. And that's all they're interested in, which is crazy. But anyway.
Yeah. I think, so, but it doesn't make, but from a repayment, whether you have interest only repayment, does not make any difference on that perspective. And if you can, just like I said, if you've got a portfolio, it might be worth putting a 1 or 2 on a repayment and then put the others on an interest. Just depends, and make it flexible.
Payam, I have a separate question then for a friend who's basically looking to buy for their first time buyers. So completely away from HMOs, back into the residential space.
Yeah.
So they're quite flexible in a lot of things. And they've asked me, so David, what's the sweet spot? Okay.
Sweet spot at the moment, stay away from 90% loan to value. There are none. There's only about 3 lenders lending on 90% loan to value. So what I would say is, when it comes to residential, it's all about affordability and deposit.
Right.
Okay.
So their affordability could go to 500. That would be a 5 times multiplier.
So there's about 5 or 6 lenders that will go up to 5
But they've got a 150K deposit. So if they take something at 350, something at 500, they're only borrowing 350. So that's well within their affordability.
Affordability is fine. How much deposit did you say they had?
150.
Yeah, so that's fine. So if we go 500 times 85%, that's 425. 500 times 15%. Yeah. So they've got about 30% deposit. That deal comes down to Anish's point. That deal will very much come down to rate. What is the best deal we can get them? Now, when you're dealing with residential mortgages, it's a little bit different because they may tell you they're on, I don't know, 50K income each, but then there are some lenders will take pension contributions into account as a loan almost. So we've got to take that away. They may have car finance, got to take that away. Then it's the type of property. Are they doing a leasehold?
And I guess maybe this is more a domain of general advice, but would it not be better to advise them, look, if you can find something for 350, don't stretch yourself. Buy something for 350, borrow 200 and, live more comfortably in your finances. Would that be, it's hard to say.
The clients, you see, that side of things, we always leave to the clients because it's up to them how much they want to borrow.
Because at the end, it's also an investment, right? So if they have a £500,000 asset and property prices double in 20 years, then they've got 2 million. But if they start at 300 and it doubles, they've only got 0.6. Yeah. So it's a very hard thing to give advice on.
And also what you're finding right now is the sweet spot in markets where you see properties between 300 to 500 are still, and it's mad to say, it's still relatively affordable for people. 400, 500. When you're the bits that are going to take a bit of a hit in this residential side, not necessarily HMOs and buy-to-lets. On the residential front, they're going to take the hit, are going to be the 800s, 900s, 750s, those type of brackets. Because if you go above $1 million, you've got people that have got incomes that cover that. It's the people that are on relatively high income, however, they've stretched themselves. Okay? They're the ones that are going to struggle. And normally that's between the 900, about 700 to 900. Okay. I think that's the sweet spot, which is going to come down. I see that's going to come down. I see new builds are going to be a problem as well. All of those new builds that you've seen under Help to Buy, all of those are going to be problematic.
Man, Help to Buy, I don't know. I reserve my judgment, but for me, it just feels like such a scam. Someone's buying something and they're paying rent on it and they're forced in the shotgun wedding with another investor.
Well, Help to Buy is a really, really big problem waiting to happen. And that's because essentially people haven't got the affordability for that property from day one.
Yes.
Okay. Yes. Because the government's giving them 20%, but that's the headline. The underlying problem is the Help to Buy is being underwritten based on 75% of the value, because the government gives you 20% loan and a 5% you put in deposit. All of the affordability is done on the 75%, not on the government loan bit as well. So
I mean, it lacks compassion, but if you only have 5%, maybe you can't afford the property is really the bottom line.
Well, there are, don't get me wrong. I deal with a lot of foreign nationals, okay? Now, IT consultants, so forth, right? These guys are on really big money, but they just don't have their cash here. Okay? So Help to Buy can work for people, okay? Especially if you're buying a house. Okay. I think Help to Buy is quite a good thing for houses, right? But when you're dealing with flats, when there's a downturn, when the downturn happened last time round, my company at the time, we were doing 7 billion. We did 7 billion mortgages in 2007. 7 billion. Wow. That's bigger than some of the buildings, well, top 10 lenders now. Okay. And what we saw was when the market went pop, all the new builds went pop because those people could not afford to live there. So number 12 put theirs up for sale for 300. Number 10 said 290. Number 11 said 182. And the prices started coming down because all of a sudden 10 people in a block are selling their properties. So what happened was those properties got devalued first. And I think the problem with Help to Buy and flats and new builds is the problem is when there is an issue, everybody will start selling up at the same time.
I mean, my moral position against Help to Buy is that it's only applicable on new builds, which have a 20% premium. So it's nonsense. It's not helping anyone.
I've said that in my videos. I've said, look, basically the developers know you're going to get that 20%. And what they're doing, they've just bumped their prices up by 20%.
And the shared ownership is that's also another shame.
Shared ownership. I've done a video on shared ownership versus Help to Buy. I think shared ownership is actually more a problem because you're not taking advantage of that asset going up in value. You're sharing that asset with somebody else. And there are also problems when you want to buy another share. They value the property higher than you. The lenders will, there are some problems about shared ownership. definitely. I'd rather go help to buy than shared ownership.
Okay.
That's personally for me. But that's on the residential, guys. I know you guys are all investors, but that's on the residential front.
Well, that's all from me. If anybody has anything else, I think we close the session. It's almost been a 2-hour one, so it's been a good one.
Thank you very much,
guys. Get in touch if you need anything. Just give me a call. All right.
Yeah,
Well, Dave, thank you.
Thank you very much. Take care. All the best. Thanks.
Take care. Bye.
Bye.
sorry.
David, just 1 minute, if you've got a second.
Leave
Me?
Yes, please.
Yeah, no worries.
me.
Let me just drop off the rest and stop the recording.